Hey guys, I've got a quick question for you today. So this is the stock of Disney, and as you can see, it has dropped quite a bit. So at this time, you might be thinking to yourself, let's just imagine that you want to buy 100 shares of this stock. You think that, $102.72, this is a good place for you to buy, and you're looking to buy 100 shares. So there are two ways you can go about buying these shares, right? So option A would be to just simply pay $10,272 for 100 shares, all right? Now the second option would be to pay $5,490 for 100 shares. Now, if it was you, which would you choose? Now, you might be thinking to yourself, is this a trick question, right? Obviously, we would want to just buy just pay $5,490 for the shares, right? Why do I want to pay more when I can pay less? And this is the thing. A lot of people do not realize that there is an option B. Okay, they thought that the only way that they can buy, the shares, 100 shares, would be to buy, just pay outright, for 100 shares, pay $10,272, when there is in fact this other option. And this other options is by using LEAPS options and LEAPS call options very specifically. So this video, I'm going to talk all about the difference between stocks versus LEAPS and give you a much more informed decision which is better for you. Okay, so if you haven't watched the LEAPS video, which I've already created before, which I've already gone in depth into what LEAPS is, you can click it at the top right hand corner. There'll be a link somewhere there. But for this video, I want to specifically talk about the intrinsic value and the extrinsic value, because that's the main difference between stocks and LEAPS, right? So stocks are 100% intrinsic value. There's no extrinsic value at all. But for LEAPS, you have a mix of intrinsic and extrinsic value. And very quickly, extrinsic value is just basically time value. All right, time value, it decays over time. That means as the option expiration date goes to zero, all this extrinsic value will disappear. Okay, so if you take a look at this option chain down here of Disney, all right, first of all, I want you to take notice of is the price is actually 102.60. This is the last traded, but we don't want to see this, because right now, if you go to the market and you hit the ask, you can buy it for $102.60. So next thing I want you to take a look at is this intrinsic and extrinsic box down here. So you can see down here, there are two columns. On the left hand side is the intrinsic column, on the right hand side is extrinsic column. So intrinsic column, very simply, is just the difference between the current market price and the strike price. So if I was to take $102.60 minus off the strike, you will get 52.6, right? Extrinsic value, on the other hand, is dependent on the volatility as well as how much time there is left in the option. Okay, so that's what you need to know for intrinsic value and extrinsic value. So now let's talk about what if the stock goes up, right? The underlying stock goes up. How much does buying shares make, and how much does LEAPS make? So let's say if Disney goes from $102.60 to $122.60, what is the profit for stocks? So for stocks, very straightforward. We have a $20 profit, and then to calculate the return, it's just you take $20, you divide it by the cost per share, and you get 19.49%, which is not bad, which is pretty decent, right? What about for LEAPS? So for LEAPS, how do we calculate the profit? So basically, a rough gauge is by taking a look at delta, right? If you're not very familiar on what delta is by now, delta just basically measures the options value, the rate of change in the options value per $1 move in the underlying stock. So if the underlying stock goes up $1, right, and all else being equal, this option value will increase by 95 cents. And if the stock was to drop $1, then the option value would also drop by 95 cents. So basically, this is what delta measures. So in this case, if it goes up $20, we just take 0.95 times $20. That is a profit of $19. So how do we calculate the ROI? We just take this divided by the cost which we paid, which is 54.9, and we want to take a look at the mark box. Right, mark is basically just the mid price between the bid and ask, because if we were to take a look at the LEAPS specifically, you will notice that the bid and ask spread is pretty wide. So you never want to just go and buy off the ask column down here, because you'll be paying more than you need to, right? Because you can most of the time get it at the mid price. So we are taking the mid price, which is 54.9. So very simple and straightforward. You can see that if you're using stocks, your return will be lower than if you were to buy LEAPS. Now, what happens if the stock was to go down? All right, what happens to the price of both of them? So you can see down here, I've created this two little bar down here that measures, right, the intrinsic value as well as the extrinsic value down here. Now, this is something that I do not see any other people talk about. I do not see any other YouTube videos that are showing this change or this bar in terms of intrinsic and extrinsic value. So this is something that you probably only can see it here. All right, so this is very important for you to understand. So I want you to just pay attention for the next few minutes so I can explain this to you. So you can see that the stock is 100% intrinsic value. Okay, so the stock price right now, $102.60, that is the intrinsic value. Whereas for LEAPS, right, you only paid $54.90. So what this consists of is actually $52.60 in intrinsic value, and you're paying $2.30 for time value, which is the extrinsic value. So how do I know? You can just simply take a look at this column down here. You can see it says 52.6 in terms of intrinsic and $2.30 in terms of extrinsic. So this is all you are paying in terms of intrinsic. Okay, so it means that if the stock actually just drops to $0, right, stock, guess what? You lose an intrinsic value of $102.60. But for LEAPS, you can't lose more than what you paid, right? You already paid only $52.60 for your intrinsic value, right? So if the stock goes to zero, that's the most you can lose. So you do not even get to lose any thing down here because you never paid for this value down here. Okay, so that is why LEAPS is a very good tool for reducing risk, because you are actually losing less if the market really goes to zero. The stock really goes to zero. Now, let's see what's the effect if the market actually drops. So if the market drops or the underlying stock drops $10, the stock is very straightforward, right? You lose $10 in intrinsic value. You can see the value is lost here. And the remaining intrinsic value, this is not correct. This should be actually $92.60. Let me just change it here very quickly. So this is $92.60 because you have already lost $10. What about the LEAPS? What do you think is the value after the stock has dropped $10? All right. So if it drops $10, right now the stock will be worth $92.60, and the LEAPS will be $45.98. So why is this so, right? You see, when the stock drops $10, the intrinsic value portion of the LEAPS also lose $10. But if you notice, the extrinsic value actually gained $1.08. So the intrinsic value lost, but your extrinsic value gained. So how do I know this is the exact amount? Very simple. Let's say on the day itself. On the day itself, you bought the LEAPS and the underlying stock dropped $10. You would take a look at the 60 strike price down here. So that's because, you see, if you were to buy at $50, the strike price, and the market drops $10, it means right now the LEAPS would be $10 closer to at the money. It'll be $10 closer to at the money. So this would be the value where the LEAPS would be at when it drops down $10. Again, assuming everything else, all else is equal, the volatility does not change. Okay, so you can see down here that the extrinsic value is $3.38, and then previously the extrinsic value was only $2.30. So that means it has gained in value. So instead of losing $10, right, just like the stock, you only lose $8.92, and the reason is because your extrinsic value has actually helped cushion the loss of your intrinsic value loss. So on the downside, the stock has no protection, but the LEAPS has the extrinsic value working for you. So many people think of extrinsic value as a bad thing, and most of the time it is, right, because it actually decays. But when the market actually drops very quickly as well, you will be actually losing lesser because your extrinsic value is helping you cushion the loss from any intrinsic loss of the LEAPS. So that's why you only lose $8.92 when you paid $54.90, right? Now, here's another question for you. What if the stock drops $60, right? We know that the intrinsic value loss will be $60 for the stock. Is very straightforward. You would lose $6,000, all right, per 100 shares. So there's a 6K loss. Now, what about the LEAPS? How much do you actually lose? Because if you see the value of the LEAPS which you paid for is only $54.90. You paid $54.90 and the stock dropped $60. So that is more than the value of the LEAPS. So what is the value of the LEAPS right now? Take a moment to just think about this. By the way, if you've enjoyed this video so far, I'd appreciate it if you hit the subscribe button and just give a thumbs up so I can create more videos like this for you in the future. Alright, back to the video. Okay, so have you come up with a guess on what's the value of the LEAPS after it dropped $60? Well, the answer is that the LEAPS did not actually go to zero. It actually still has a value of $11.10. So how do I know this? Basically, all you have to do is just take a look at the 110 strike price. That is because if the stock was to drop $60 and you bought a strike of $50, that means the stock right now is $42.60, your $50 strike will be out of the money, right? So it will be $60 down from this strike price. It will be down here, and again, all else being equal, you will see that the extrinsic value, there's still $11.10. There's still $11.10 left. It's not zero. So why is it that way? Well, again, that's because the intrinsic value, first of all, you can't lose more than the amount that you paid, right? You paid $52.60, even though if it drops $60 or it drops $100, you're only going to lose $52.60. So your intrinsic value becomes zero. Now your extrinsic value, on the other hand, it actually gains value. So it gains to $11.10 as you have seen here, right? So it has gained a value of $8.80 on the way down. So you can see again the extrinsic value has come in to help you cushion this loss down here. So instead of losing the full value of the $52.60 in terms of intrinsic value, your extrinsic value helped you cushion that, and the total loss which you would experience from this LEAPS would be only $43.80, right? You bought it for $54.90. You only lost $43.80. Whereas for the stock, you have lost $60, which is $6,000. So here's the thing. When the market goes up, LEAPS make more than stocks. As you have seen, the return is higher. And as stocks drop down, you actually lose less because of this extrinsic value down here. This extrinsic value helps you cushion any loss that you made on this intrinsic value, right? And then it still gives you a chance, because if there's still time left and the market goes back up again, you will start to gain back intrinsic value. And of course, on the other hand, you will start to lose this extrinsic value. So it's kind of a little bit like a tango back and forth. But the key thing is that this extrinsic value can help you cushion on the downside. So on the upside, you make more because you are actually paying less. And on the downside, you actually lose less compared to buying shares outright because you have this extrinsic value to cushion you. So I hope you understand a little bit better about LEAPS and why this can be a very fantastic tool for you, especially if you look to get into that particular stock for a long period of time, about a year or 2 years or so. So you might want to consider buying LEAPS rather than just buying shares outright. Alright guys, that's it for this video. If you like this, please subscribe and hit the notification bell so you'll be informed whenever I release a new video like this. And as always, thank you for watching. Appreciate your time, and I'll see you in the next video.